Hello and welcome to our fourth webinar in farm finances. This last webinar is working with a tax professional. I will let you know right now, it might help if you have the income statement that we put together in the previous webinars for TLC farms. But to get started, the main goal of this webinar is to show the basics of a farm tax return and working with a tax professional. It does not explain how to do your own taxes. Tax laws are very complicated and nuanced. So we highly recommend that you find a tax professional who understands farm tax returns and doing your own, and what you'll find is doing your own taxes could cost you money, or you could leave money on the table if you don't do them correctly. Tax planning is an important part of running any business, and you must file a tax return every year. Even if you do not make any money at your farm operation or in general, you have to file a tax return. So before we get started, I'm going to introduce Gary Bressner. Gary Bressner is a retired ag lender, and he has been doing taxes for how long now, Gary?
Well, I was with FBFM, the University of Illinois Farm Business Fund Management Program, for 20 years. I did them for over 20 years while I was at the bank. Now another 5 or 6, so let's say in the 45 to 50 year range.
Okay, so he has a few years of experience when it comes to taxes. And I will say we have used him ourselves on our farm, so we trust him, and he's my go-to for questions. So
I am an enrolled agent as well. There are 3 designations. There's attorneys, CPAs, and enrolled agents. Enrolled agents pass a series of 4 examinations over several days with Internal Revenue. And then every 3-year re-enrollment cycle, we have to have 72 hours of continuing education to maintain that status as well.
Right, so he is well versed in all of this and very familiar with farm tax returns. So the agenda for today is Gary's going to talk about what's on a 1040 tax return, some common non-farm tax documents you need to file a return, Schedule F basics, what is a Schedule F, for example, and then we're going to go through an example with Jane Farmer's tax return of the TLC farm. The first example would be as though Jane Farmer, and I will be playing the role of Jane Farmer, filed a tax return without using someone like Gary, a professional. And then example 2, we'll have Jane Farmer meet with Gary, her tax preparer, and we'll see what the difference is. And then finally, just little thoughts that Gary had at the end that we're just going to add in there. So with that, I'll turn it over to you, Gary, and you have the floor.
Well, basically here we're just going to discuss a little bit of the format of the Form 1040. 1040 has evolved many times over the history of it, with income tax laws beginning back in the early 1900s, I believe in the teens actually. And this 1040 actually took quite a bit of design reformatting and stuff about 2 or 3 years ago with some things that were going on as well. Basically, the top portion of the 1040 that you're looking at here, first of all, it's kind of the filing status, whether you're filing as a single, a married filing joint return, married filing separate, head of household, or qualifying widower. Then next, it's basically the name, your address, your tax identification or social security numbers and stuff. Fill out the rest of this top portion. Just below that, then you start getting into the dependents that can be claimed in your tax returns. That's including the name, the tax identification numbers, and the relationship that those potential dependents have with you. To qualify as a dependent, typically it would be a youth, a child under age 19, or if they are full-time students carrying at least a 1/2 load at qualified educational institutions, it can be up to age 24, that those individuals can typically be claimed as a dependent. They must live with the taxpayer for at least half of the year, and you must be providing at least 50% of the support for those individuals. And that individual can't be a qualifying child of another taxpayer. So again, where that typically is going to be addressed in several of these things, in the case of separated or divorced families, both parents can't be claiming the same child as a dependent. Commonly, the custodial parent who a child is living with is the individual that can claim the dependency exemption for that child. But they can release that exemption to the other parent, especially with child support and other agreements that can be happening and stuff, as well. So there are some additional nuances in there that we're not going to take time to discuss, certainly under this type of a format. Currently, on the 1040, there are not direct exemption deductions for the number of family members like there were numerous years ago. That reform happened a couple of years ago when we significantly increased the standard deductions that we're going to be talking about just a little bit. So it does not have a direct implication in adjustments for taxable income like it has in the past. It does, however, have an implication on child tax credits and other credits that will show up on the tax return for children. And then also those exemptions still carry over to the state of Illinois tax return where they are still getting exemption allowances, and it reduces your taxable income for the state of Illinois. But basically, that's the information on the upper kind of third or so of the 1040 page 1. Then you get into the areas, which is basically accumulating the income and the deductions. Lines 1 through 7 are the very, very typical type of incomes that most people are familiar with. Line 1 is being the wages from your employers. Line 2 is interest income. You can have 2A as tax exempt interest, 2B is taxable interest. The only one that's included in taxable income for most people is that 2B amount. But there's a reference item for tax exempt interest because for very high income individuals, there are other taxes that come into play, and some of that tax exempt interest can in fact be taxable in other ways. But then also this tax exempt interest commonly will be taxed on the state of Illinois return. For dividends, line 3B is the total taxable dividends that you have. 3A is an informational box. The number that is there is part of the 3B total, but those are from dividends from qualified corporations that let you get the benefit of those dividends being taxed preferentially and taxed like capital gains, which is a little bit lower tax rate for most people. Line 4 is for IRA distributions, and 4A is for total distributions. 4B is just the taxable portion, because you can have some of your IRAs that have basis in them and it's not fully taxable, or it can be distributions from Roth IRAs that are not taxable in most instances. So there is a larger amount from time to time in 4A than in 4B. Pensions and annuities can be the same way. You can have total distributions, but there may be some basis or other things that mean it's not fully taxable. So line 5B is just showing the taxable amounts. Social Security benefits are the total benefits paid to the individuals. Not all of that is taxable. In fact, it can't be more than 85% that is taxable. And if you are a low enough income individual, it's possible that none of the Social Security benefits are taxable. There's a whole separate little calculation that goes into that. But that's why there is the whole A columns 2 through 6A to give information, but it's the amounts that show to the far right that are actually the taxable amounts. Line 7 then is capital gains, whether they be short-term or long-term, and they flow through to the front page here from a separate form, a Schedule D. Then we go to other income. With some of the reformatting or changing of the 1040s that happened 3 or 4 years ago, the 1040 was consolidated and had fewer lines on it. It didn't mean that it eliminated sources of income or anything else. It just meant that they had to create some schedules which now pulled together various income sources and then just carried the subtotals forward to the line 1040. So at the bottom of this screen, you see Schedule 1, and this is page 1 or section 1 of, or part 1 of that. It brings additional income like alimony on line 2, or line 3, it says Schedule C. Farming is very unique in that it is the only business that has a dedicated form just to it, so that there's terminology on the Schedule F that references farm income and farm expense items more directly than a Schedule C. All other businesses, self-employed businesses, are reported on a Schedule C. 4797 is also for reporting business type of stuff, but it's the capital assets that are sold, whether it be real estate or farm machine and equipment or breeding stock that will start out on Form 4797, and then by the nature of those incomes determines where they will show up on the rest of the 1040. Line 5 is for rental income and royalties and your share of income from partnerships, sub-S corporations, trusts, estates, and those type of things. And then we get to line 6, which is where the income from Schedule F flows through to. But then you also have unemployment and other things. The point being, the Schedule F income is going to carry through to this line 6. It's part of the subtotal that will show up back on line 8 of the 1040 at the top. So basically, it's just the flow of how things show up on the returns. Then we can go down to basically other adjustments. This is now Schedule 1 still, where income was being summarized a moment ago. This is the backside, page 2 or part 2 of that. And there are many adjustments against income that show up. In this particular case, you've got things like educator expenses, where school teachers and teachers' assistants and administrators can deduct up to $300. It's not enough because those people put a lot more investment into their classrooms than that. But when they've got expenses out of their pocket, it gives them a place to deduct a portion of that. You've got health savings account deductions that many individuals take advantage of that allow you to set aside and some income, reduce your taxable income, and dedicate those funds to use to be paying medical expenses. And as long as you take that money out and use it to pay true qualified medical expenses, it is not taxable. Line 15 is the deductible portion of self-employment tax. As self-employed individuals, you pay Social Security and Medicare on yourself because there's no employer that is involved in it. And you get to deduct up to half of that self-employment tax. It comes in your line here. Line 16 is for business retirement accounts, SEPs, Simples, and other qualified plans. Self-employed individuals can also deduct health insurance costs on line 17. Alimony expenses. Line 20, IRA deductions is something individuals take advantage of. Line 21 is student loan interest. But there are other such things then that as we go on down, all of these are subtotal at the bottom and are carried forward to the 1040 as an adjustment against the income. Kind of in the next slide, then we start out the one next line down. We had the total income just a little bit higher. We just deducted the adjustments to income that we just referenced. And it brings us to a line that is quite commonly discussed as adjusted gross income, or the acronym of AGI. And AGI is a number that is used to help determine eligibility for a lot of things. Even as we had stimulus credits that were paid on tax returns in the last several years, if your adjusted gross income exceeded certain levels, you didn't qualify. As long as you're below, you did qualify for those. You even have this used for USDA eligibility for farmers, because if your adjusted gross income on a last 3-year average exceeded a certain level, you might not be eligible to participate in government programs and subsidies. As long as you're below that, you do. So adjusted gross income is used for actually quite a few things in that particular regard. The next lines down give you deductions for either standard deduction on 12A or itemized deductions. The standard deductions are referenced in the lower left of this slide. For single individuals, it's $12,550. For married filing jointly, it's $25,100. Head of household is $18,800. These are about twice as large as they used to be, just as a standard deduction. The intention was being so that people didn't all have to itemize. When you itemize, you're adding up such things as medical expenses above a certain threshold, your residential mortgage interest, real estate taxes paid on your residence, charitable contributions, state and local taxes, and some other such things that can be taken into consideration. If you add all of those up and you're on a single tax return, and those itemized deductions exceed the $12,550, then you're going to take advantage of that. On line 12A, you would show the itemized deductions, and that subtotal is calculated on a form Schedule A. For most individuals anymore, though, the standard deduction is high enough that that's what you will be using, and that's what shows up on line 12A. If you do use the standard deduction and don't itemize, the last 2 years, we've been given an additional deduction for charitable contributions. I believe that was done probably to give a little bit of additional incentive for people to make contributions to charities that maybe was lost with the large standard deductions and fewer people itemizing and feeling they didn't get as much tax deduction. So if you use standard deduction on a single return, you can deduct up to $300. On a married return with 2 individuals, up to $600. But those then adjustments are subtotaled here on the line 12C. And then we get to the bottom of the 1040. One other deduction that comes in prior to calculating taxable income was also a new one created about 3 to 4 years ago. When President Trump was trying to reduce taxes on businesses, he was able to do that with C corporations by lowering their tax rates to a flat 21% tax rate. But he wanted to impact or reduce taxes on all businesses. And other than C corporations, most other or pretty much all other sources of business income flow through to personal tax returns, either as part of your distributive share of rental incomes or income from sub-S corporations, from partnerships, from trusts, or if you've got income that's being flowed through you on an estate, or if you're a self-employed individual, your income flows through to a personal 1040. So to provide some tax relief for those businesses, we got up to a 20% deduction or reduction in taxable income on business income. And the business income in this particular case was defined as whatever that net income was, reduced by some business deductions. The one here for the 50% of self-employment tax deduction, the ones that was including health insurance and the business retirement plans. So we took the net incomes minus those, and that got us down to what was called qualified business income. And up to 20% of that then could be used tax-free, the last about 2 to 3 years in that particular regard. But after all of these other adjustments, we finally get to the bottom of page 1 of the 1040 and arrive at taxable income that actually is carried over into the tax tables. Backside of the 1040 then is where income tax is being calculated. And here we just kind of get a quick move down to line 24 for the total tax. There are lines 16 through 24 that are above this, and it's bringing in first of all, the income tax that is calculated most of the time off of tables. If your income is very, very high, rather than tables, it's kind of on a percentage calculation basis that you can see. I think there's an example a little bit later on. But the income tax is calculated at the top of that. It is reduced by some of the non-refundable tax credits, but then we add in other taxes in addition. Some of the non-refundable tax credits, just as an example, would be like in the past, child tax credits or child care tax credits is a better way of saying that. When you had babysitting costs, those costs could be used to offset tax, but it could not exceed the tax liability. If you had $3,000 worth of child tax credit available to you, but you only had $2,000 worth of income tax, then you only got $2,000 of benefit. The rest of that was not refundable. So up in the top portion of this, non-refundable credits were brought into place. But then we had to add in other taxes. And one of those taxes is self-employment, which is Social Security and Medicare for self-employed individuals. If you're an employee, your employer is withholding 7.65% of your wages for Social Security Medicare from you. And the employer has to provide an equal 7.65%. When you are a self-employed individual and no one is collecting that and sending it in, then you're responsible for actually paying it yourself. And it's actually between 14 and 15%. About 14.13 is what it nets out to be. But that is added in as additional taxes. But that all is summarized then into this particular line 24, which is total taxes. Then from line 25 down to line 32 are various forms of payments or credits. The very common one is on 25A, where you've had income tax withheld from your W-2s. Less commonly are off of 1099s, but there could be withholdings on some of those, as well as other forms. Line 26 is for estimated tax payments that as a self-employed individual, where you do not have an employer that is doing income tax withholding on your behalf and sending it in, you have to still be paying in a portion of your taxes throughout the year's time period. If you qualify as a farmer, you have to have at least 2/3 of it paid in by January the 15th for you to pay as late as April 15th on a tax return. Or as a farmer, you can just skip estimates, but you have to file your tax return by March the 1st. All other taxpayers, instead of the 2/3, have to have 90% of their tax paid in throughout the year's time period. To qualify as a farmer, though, you have to have not of the net income, but of the gross income, at least 2/3 of all the gross income represented on your tax return has to be from your Schedule F farm proceeds. So if you have non-farm wages in addition to farm income, you still may not qualify as a farmer for that purpose for estimated tax purposes, even though you are farming. But line 26 is where you bring in those estimated tax payments you make throughout the year to reduce the tax you owe on the return. Further down, we have line 29, American Opportunity Credits, which is educational credits, and line 30, which is the recovery rebates that we've gotten the $1,400 in recent years. But all of those payments and credits then are added up in line 33 to give the total credits against the liability you owe. And then we get to line 34. You have either overpaid, or you get down to line 37, you have underpaid and you owe. Line 34, if you have refunds, you can either ask IRS to send it to you in physical check form, or you can give them the routing numbers and account numbers on your bank information, and they can send it directly to you. Or on line 36, you can let those refunds be credited toward the following year as part of your tax estimates. But then bottom line, the amount that you owe obviously is an amount that you're going to either physically send in or have IRS directly deduct that from your accounts. As far as looking at some of the common documents that we're needing to have that you need to be taken to the professionals, obviously W-2s are the very common one. It reports the gross wages that you receive from an employer, well, the taxable wages that you receive from an employer, as well as the gross wages that can be a little bit below that, not all taxable. It shows the amount of income tax, of Social Security and Medicare and state taxes that are withheld. It also provides you with some of the information on tax-free benefits that are used in the adjustments of your income. 1099s you may receive from individuals that you receive money from. 1099 MISC or miscellaneous is to report rents and other income. About 2 to 3 years ago, they created specifically a form NEC for non-employee compensation. So this would be one if, as a self-employed individual, you did work for someone or contracted labor for someone, that they would report this to you and to Internal Revenue. And that tells IRS that this is income that is not only taxable for income tax purposes, but you probably do owe self-employment tax, Social Security and Medicare on it as well. 1099 INT for interest. There's also 1099 dividend that's not on here for dividends. The 1099Rs are for distributions from pensions and annuities and IRAs and various retirement plans. Another that we don't have on here, but that you may be receiving, would be K1s. And a K1 is referencing income that you may have coming through to you as your distributor share from a partnership that you're involved with, or from a sub-S corporation, or from a trust, or from an estate. The W-2s and 1099s commonly are supposed to be to you by January the 31st. K1s do not have that requirement, and I hear that from a lot of people. I don't get it in time. Those entities also are receiving 1099 information from other payment sources that they have, and so they don't have to get those out by January 31st. So sometimes that causes some problems for filing delays or issues, especially for farmers that are due by March 1. If you've got K1s that are coming that we just don't get in a timely fashion. So the Schedule F, and we're going to look at those in a little bit more detail in our examples here in just a few minutes. But basically, we're just seeing the top of the three forms here. The Schedule F will have the income shown at the top, expenses at the bottom, and in the lower right corner will be the net farm income. That flows through to the Schedule 1 that we referenced, and it's part of the subtotal that is carried forward to line 8 on the front page of the actual 1040. A Schedule F basically reports the net income of the farmer. And to get net income, you start out with the gross income and then minus all the expenses. And there are several categories of income that are shown at the top. Some of that is done through the Internal Revenue can try to match up the information returns, the 1099s that you receive from cooperatives, from the U.S. Department of Agriculture, from individuals for whom you did custom work or various things of that type. And so it gives individual lines for IRS to try to match up those income sources. And then the expenses at the bottom of the Schedule F are broken out categorically to match a lot of the things that you do in agriculture. A Schedule F can either be filed on a cash or an accrual basis. And many of you have never heard of the accrual, and it's not a commonly used form of filing on a farmer's tax return. Cash basis is by far the most common. Accrual basically is letting you, it's kind of a hybrid accrual system, different than what the corporate business world is. We're allowed to deduct our expenses in the year in which they are actually paid. But crop and livestock income is reported more on an as-earned basis. And maybe the best example of that is if you were starting farming in 2022 and you did not sell all of your grain out of the field, you still had some of it on hand December the 31st that carries into the following year. The market value of those grain inventories on hand at the end of the year are still included in your gross income for your 2022 income tax return. So it's more as it was earned, whether or not you sold it. Then in 2023, whatever your actual sales are in the year's time period, you reduce that total by the inventory amount that was already reported in the prior year. So it's not doubling up. You're using that inventory to reduce the income that following year. So that really all you're doing is, if you estimated that you had $100,000 worth of inventory year end, and so that was included in this year's income, but you sold $105,000 actually because you had more bushels on hand or the price went up, that additional income is included the following year, the adjustment above and beyond. Like that though, if you had less income because inventory was overstated or market prices dropped, that's a reduction next year. So that's basically how the income side of it works on the accrual. The expenses are deducted just as you pay them. Cash basis just doesn't worry about bringing in that inventory at year end. It's truly as you received it. It's on an accounts payable basis. If it's available as income in 2022, it's reportable this year. And when I say it that way, it's kind of a reminder, it's an accounts receivable or it's actually available to you. If you sell grain at an elevator in December and the check is made out in December, you either just choose not to go pick it up, or you pick it up but decide not to deposit it till after the first of the year. That is income in December of 2022 because it was constructively available to you and in your possession. So that is not something that you can do in tax planning. That is taxable. It is received in the year in which the funds are actually available to you. Most individuals file on a cash basis, and a lot of that is because that's how they started. You have to make your decision on the first Schedule F that you're going to file. You can change, but it's a very costly and complicated method in doing that, so I commonly would not recommend it. So however you start out is how you are going to continue. And we're not going to go into discussions of the advantages or disadvantages of that today. That's a whole different discussion. It gets kind of complicated and is determined a lot of time by the beliefs of the individual as well. But I think that's enough said on it, but there are options available.
So as we mentioned, we are talking about how to work with a tax professional. So we're going to go through a couple examples. I'm going to take on the role of Jane Farmer, owner of TLC Farms, which, if you recall, we did her income statements in the previous webinars. And on the first one, Jane is not going to use a tax preparer. She's just going to use some software and take that income statement on a cash basis and just put it on into the software itself, and not choose to use someone like Gary. A couple of, like I said, a couple of assumptions for the example, cash basis filing. It is the most common and is the most common that we see on the ag lending side as well. And it tends to be easier than both options because it's basically what goes in your account and what comes out of your account. So a lot of people, it's a lot easier for them to file on a cash basis. So, and also for this example, we're just going to say that Jane Farmer also has a W-2 off-farm job. So on the first one, we have on the left there, we have her income statement, her cash basis income statement. If you recall, she had $49,500 worth of income. And if you look over on the right on the Schedule F, you will see that in box 9 there, $49,500. Then she has cash farm expenses. And if you recall, when I said if you were going to set up your own income statement in Excel, I specifically said use your Schedule F as a guidance for your expenses, your expense categories. This is partially why, is so that you know you have it covered when you go to do your taxes. You have everything that the taxes, for the most part, will cover. So she just transfers the fertilizer over the fertilizer box and so on and all down the line. So her total cash farm expenses is $51,375. And her net cash farm income is negative $1,875. And you transfer that over to the Schedule F there. So gross income minus your farm expenses, that's where the negative 1,875 comes in. So we transfer this to the 1040. Like I said, Jane Farmer has an off-farm job. She made $40,000. That was her W-2 wages. That goes in box 1. Line 8 has the total from Schedule 1, which if you remember, the Schedule F goes to Schedule 1, and then it shows up in line 8 on the 1040. So there you'll see the negative $1,875. Line 9 is a total of all the income. So 40,000 plus the negative 1,875, you get 38,125, which then transfer down to down to line 11, since there are no adjustments to income from Schedule 1. Line 12A is where Jane Farmer takes the standard deduction for a single person of $12,550. Subtracting this from your total income gives you taxable income of $25,575. Line 16 has used the information on line 15 to calculate Jane Farmer's total tax, which has been calculated. And here's just kind of a rundown on how it works when you're in the tax tables. Basically, the first is 10% up to $9,950. And then the second bracket would be 12% up to, what is that? Up to
Well,
25,000.
and actually in this particular case, when you kind of look at it a little bit here, let's go back and think just for a moment. Jane Farmer, the first $12,550 was tax-free because that was her standard deduction that we were looking at. So that's totally tax-free. Then for a single individual, the next $9,950 is taxed at 10%. Then between $9,950 and $40,525, that is taxed at 12%. So she's got income here in the 12% tax bracket. That does not mean that all of her income is taxed at that 12%. And that's fairly obvious here because there's $2,870 worth of income or of tax rather on the total income that she had. So that's how it kind of works. You can work it out on the percentage basis like this, and where Sarah's coming out with this 2870 by calculation. Actually, it goes to the tax tables, and they're $50 wide in income. So you can calculate it here by this percentage basis, and it'll be a few dollars different than what the tax brackets will show because it calculates the tax in those middle of those $50 income wide brackets.
Okay, and then from Jane's W-2, we see that she already had $4,000 withheld from her paycheck throughout the year. So Jane, in this case, is getting a refund of $1,130. As Jane Farmer, I'm very excited to get my refund. So let's talk about example 2. Jane Farmer decides to hire someone like Gary and to go over her taxes. So Gary, I brought you my W-2, but here is my Schedule F here. Is there anything you need to know from me as far as how this works?
Well, first of all, we kind of look through the income and try to look at the reasonableness of the expenses and the income items relative to your farming operation. And in this case, Sarah obviously, or Jane Farmer, keeps a good set of records, so I'm not questioning the accuracy of those. But one of the things that I would prefer as a tax preparer is not to have a negative income showing up on the Schedule F, whether or not it is on a Schedule F for a farmer or a Schedule C for someone that is businesses other than farming. It's nice to have the refund that you are coming up with here, but in many instances, your expenses may be benefiting you greater in other years that you have positive income. And my example of that is, in this particular case, you've got $1,875 of negative income. That if that was a zero, it means we could have had 1,875 of these expenses deductible in the following year. And if we had a positive income in those years, those expenses would not offset just federal income tax and state income tax, but by helping to lower a positive farm income, you'll be paying less self-employment or Social Security tax at that 14 to 15% rate. In fact, this $1,875 of expenses that are saving you not one penny of Social Security tax could be saving us $265 of Social Security or self-employment tax if it was making a smaller positive Schedule F instead of adding to a negative. So tax planning and tax preparation is a matter of, in the long run, trying to optimize taxes and have them the minimum at levels that they should be, not necessarily having income as low as you can possibly get away with. So as we did that, I started looking at expenses. We can't change the income side of it, but we really can't change the expenses, with some exceptions. This is an individual that I think was fairly early in their farming career, if I remember right from the kind of discussion with Sarah. And one number that jumped out at me with kind of the years of experience is $10,000 worth of repairs. And for someone just starting out, that seemed high. It may be very, very accurate if you have been given or you purchased a lot of used equipment and there was just a lot of general maintenance type of stuff that had to be done to it. But then another thing could be is I would ask her, is there anything major in there that wasn't just general maintenance, but in fact extended the life of a piece of equipment? Because general maintenance means I am doing minor repairs, I'm changing the oil in it, I'm doing maybe the tires and stuff, which are also a major expense anymore. But if I'm mechanically improving that by changing the motor or putting in transmissions or a whole new rear end, I may be taking a piece of equipment and now extending its life for another 10 years or so. And so I asked Sarah at this particular time what kind of numbers or what things were included in that $10,000.
Jane Farmer, not Sarah, said that was major overhaul of a tractor, and I'll be able to use that for years to come.
And the reason for asking that question is, you can see on the Schedule F we had just a little while ago, the repairs on line number 25 was $10,000. Instead, I have chosen to take that, and it's the kind of the equivalent of buying that tractor over again. I'm extending its life. I can move that, in fact, to depreciation. Depreciation basically is on a depreciation schedule where you can make major capital purchases and you can recover that cost on your tax returns, typically over a period of years. And we're not going to go into details of depreciation today. That's a discussion for another day. But the common life for used equipment is a 7-year depreciable life. There's straight line and accelerated depreciations. We're not going to talk about those either. But one of the things that you have under depreciation is you're allowed to take what is called a Section 179 election. That allows you to write off a significant amount of your capital purchases in the year of acquisition if you choose to do so. That actual maximum can be over $1 million for individuals that are very, very high in income. That's something that most of us do not push that. But basically what it means is, instead of taking it off under repairs, if I put it on depreciation, I can write off about however much or however little as I want to legally to come up with the answer that I would like to have on this particular tax return. And the rest of the expense that I don't write off in the current year will then be written off for the next 6 years or so over that 7-year depreciable life. And in this case, by having a 0 on line 25, we've chosen, there's a form 4562 that summarizes depreciation, but we've chosen to use on line 14, $3,121 worth of depreciation in this particular year. The reason for that then is we're going down into the lower right. We've got $5,004 worth of positive income. Now, when you have the negative income, yes, it can be used to reduce your taxable income. It was used to offset some of the W-2 income or other sources of income that you had, increasing those refunds. Here, we are intentionally allowing our taxable income to be higher. In this particular case, we chose to do it at a level, you'll see in just a little bit, that allowed her still to have a very small refund. We didn't here early in her farming career intentionally start making her cash flow for taxes, but we're just deferring the additional repair expenses to future years to offset future income, hoping that in fact it's going to be more tax beneficial then, because the long-term intent is for you to make money on all of this stuff.
Right. So Jane Farmer wants to know, I will get the full benefit of that expense. I'll just get over time rather than all in 1 year.
That is correct. It's just a timing issue. But in this particular case, if you had positive income in the next 6 years, that expense that is deferred is going to save you another 14 to 15% of tax that is not going to save you on this particular tax return because it's being used to offset self-employment tax.
Okay. So some things to note. Note that line 34, the net farm profit or loss, does not match the cash income statement. By moving that repair bill and depreciating it over time, we have changed that line 34 and it does not match the cash income statement that we did in Excel. And Jane's tax preparer, Gary, saw a high repair bill and asked, was that a significant repair? Did it extend the life of the tractor? Some question as simple as that. Being a farmer, I don't do the taxes on a daily basis. I wouldn't know to necessarily ask that question or even think of spreading that out over time through depreciation. So like we said, instead of taking all $10,000 in deduction in 1 year, Gary recommended we take it out over a few years. This gives Jane Farmer a positive net profit on her TLC farm Schedule F for 2021.
And another particular, part of that thought too is part of the Internal Revenue audit selection, and there are fewer and fewer audits than what there used to be because they just don't have the personnel. But they will look at the categoric expenses shown on your Schedule F in relation to the gross income at the top. And when things are high, 10,000 repairs in relation to 49,000 of income may be high by their computer comparative standards. That also increases the chances that IRS is either going to send you a letter or that you can in fact be audited. That's the only way they can look at it is the expenses in relation to the income. And especially if this is a beginning farmer and not all of the crop is being shown in here, your expenses may look very, very high relative to that income. IRS, on the other hand, if instead of deducting it under repairs, we deducted it in depreciation, there's nothing that they can really do about that, nor will they question it, because the standards are so high. We can use that 179 election, we can write it off there. So you may have problems or questions from IRS why are repairs so high. The only thing they can question under depreciation is whether or not it actually is an expenditure that you made.
Okay. So if we go back to our 1040, it looks very similar up at the top. Jane Farmer has that $40,000 off-farm wages. Line 8 has now included the positive Schedule F of $5,004, which means line 9 in total income is now $45,004, which then transfers down to line 11 since there are no adjustments to income from Schedule 1. Line 12A is where Farmer Jane again takes that standard deduction for a single person of $12,550 and subtracts that from the taxable income of $27,450 on there. So that's for taxable income is $27,450. So line 16 has used the information on line 15 to calculate Jane Farmer's total tax. For total tax is actually $3,805, and you will see that there actually on line 24, it's on there. So $3,098 of that is income tax and $707 of that is self-employment tax. And again, she had $4,000 withheld already. Jane is getting a refund of $195. Now you might be saying to yourself, that is not nearly as high as over $1,000 in refund. Why should Jane be happy about that? So that leads us to, should getting a refund be a goal?
Well, yes and no, but actually, the goal is to make money in your business. When you keep records, you're keeping records for business management purposes. And a side benefit of those is having the information that's necessary to file a tax return. And in the long run, if you are self-employed and you are making money on your business and on your tax returns that is reflected, you're going to have taxes that you'll owe above and beyond the income tax that's being withheld from your wages. So in the long run, if you have a refund, it's because we're sending in tax estimates and you're just a little bit more than they had to be. In the long run, you really want to be optimizing your taxes and having taxes at the lowest level that legally you can, while still generating and having income that is high enough to service your debt servicing and your family living needs above and beyond the business expense needs for your business. Generating just a refund is not the purpose for it. And in the long run, you can in fact cost yourselves more money.
The best way to know that you are taking advantage of all applicable credits and deductions is to work with a tax professional who understands farm taxes. Gary, in your experience, how much has taxes changed from when you started doing taxes to today?
Like a difference from black to white. It's just unbelievable. I started doing tax returns back in about 1982 when I worked with FBFM, University of Illinois Farm Management Program or Associated Program. And tax returns, every time the government gets involved, get a bit more complicated and take longer. And just jokingly, we can reference the fact if you look at the bottom of most of these tax forms, they will reference the Paperwork Reduction Act that was passed probably 25 or 30 years ago. And I'm not sure that Congress knows what that means.
It's a lot of paper. So from year in, year out, could there be policy passed by Congress that could greatly affect a farm tax return?
Absolutely, especially the last several years with what we have been going through in relation to the pandemic and the special programs that were created to provide additional funding to businesses and to individuals. There's a lot of people that may have missed out on some of those opportunities, PPP loan activities and other such things that were done through local lenders, but that the tax preparers were heavily involved in that. The last 2 years, especially, I think, are a good reason or a good example of why people need to do tax planning before year end and know before the year end, at least in best estimated terms, where you are at and therefore how you need to adjust your income before year end if you've got the flexibility to do so.
As a former ag lender and current tax preparer, where does tax planning rank in importance of a business? Is it absolutely necessary as much as balancing a checkbook or anything else?
Equally with balancing the checkbook, with doing your good business management and your tax planning, because all of those go hand in hand and all piece of the pie that you've got to be a part of.
Okay.
In my opinion.
Which leads to Gary's final thoughts. And we have talked about this numerous times in the other webinars. The key to all you do in your business is good records. You need it for business management to make decisions on a day-to-day basis, on a long-term, short-term basis, everything. Tax planning with people such as Gary, and also tax accuracy, so that if there is a chance you get audited someday, you will have everything lined up and you will have done everything by the book and stay out of trouble with the IRS. So again, make sure you're doing your financials, do them as often as you need. I recommend don't wait more than a quarter every year. You need to be updating your financials just so you don't get behind on it. And make sure you're thinking about what you're doing for taxes before the end of the year. That way you can make adjustments if needed. So again, there is my contact information. If you have any questions on taxes or want to know someone who does taxes for farmers in your area, please feel free to give me a call. I can always get a hold of Gary. Again, Gary is currently doing taxes, but he's semi-retired basically, so he's trying to wind down, but he is a wealth of knowledge. And so if you are looking for help and you want someone in your area, be sure to give me a call. I'd be happy to come up with a few names for you to go to. And with that, thank you very much for watching this fourth webinar, and good luck.